So even though we don't have a huge amount of dividend-focused ETFs here in Australia, those ETFs that focus on income rather than growth, here is a simple checklist that I use when I'm trying to narrow down which dividend ETF is the best, just to make things a little simpler, and you won't need a spreadsheet. So there are only a handful of true dividend-focused ETFs here in Australia. However, you don't need the income or dividend label for it to be a good dividend ETF. Even one that's focused on growth might be actually good for income as well. A lot of index and broad market ETFs also pay a pretty good income. So this is more about filtering out the ETFs that don't meet our criteria so we can focus on the ones that do. So starting with checklist item number 1, you want a fund manager that has a good reputation and is well established. So the ones that I like best are Vanguard, BetaShares, BlackRock, VanEck, SPDR, Russell Investments. These are all great fund managers with good proven ETFs. Now the reason you want to stick with the more well-established fund managers, even though a smaller fund company might have a good ETF, mostly it's because there's a lower risk of closure. A lot of the smaller companies, if they're not making enough money in that ETF, in that fund that they've produced, will close it down. So as a long-term investment, it's not a good option. There's usually better tracking and administration in the larger fund managers. They've been doing this a long time and they know how to produce a good ETF and choose good companies for that ETF. Number 2, you want the ETF to be quite large, quite popular, and have a lot of liquidity. Now, a larger ETF doesn't mean just lots of companies within it, but that a lot of people are investing within it. And the reason is that a lot of smaller ETFs can close. If the fund manager isn't making a lot of money or there's not a lot of people interested in that fund, they are likely to close that fund. Whereas larger ETFs, the ones that are more popular, because there's more trading, you're more likely to get the price that you want, both selling and buying. So you're not going to be stuck with an ETF that nobody else wants. Third, you need to check the fees. The management fees on funds vary quite a lot. Generally, the rule is that the more passive a fund is, if it's just following an index, the lower the management fees will be, and the more active it is when there's more trading going on within that fund, then the higher the fees will be, because they will directly reduce the yield or the return that you're going to get over time. So the basic rule is if two ETFs look pretty similar, they have similar companies, they follow a same index perhaps, choose the one with the lower management fee, unless there's some other issue with that fund. So say you've got a list of potential ETFs now, the fourth thing you need to look at is the past performance. And you want to look at both growth and income. So what distributions have they paid in the past? Have they been consistent? ETFs use distribution yield rather than dividend yield because the dividends are paid to the fund and then they distribute that out to investors. So I would look at the price growth. You can just get this from Google, and also the income, how much distributions they've paid. That's going to be shown in your trading platform, or even Market Index has that information as well. Look over 2 years, 5 years, and 10 years if the fund has been around that long. And remember here, you are not chasing at the highest yield. You are looking for the most consistent income and growth over the long term, because you want your income to be stable and growing over the long term. And also very high yields can be a red flag because they're often not sustainable. So you can easily check this out by looking at the past distribution payments to see if they've been consistent, to see if they've been growing. Mostly you're just looking for stability. And especially you want to know if it's been cut before. It's very rare for a fund to cut a distribution. Companies sometimes do it when they're trying to hold cash to grow the business, but for a fund which holds a lot of companies, oh, if they do, that's a red flag. Remember that stable and boring beats flashy and unreliable every single time. And the last thing to look at is, what does the ETF actually hold? What are its top 10 holdings? Because we only have a limited amount of companies on the stock exchange here in Australia, especially ones that pay dividends, you'll find that a lot of the income or dividend focused ETFs, they hold the same companies. So just have a quick look at what companies that they're holding. Are they heavy on banks and mining, as a lot of them are? Are they diversified across a lot of sectors, which is a great thing? You do tend to find that a lot of the dividend-focused ETFs here in Australia do tend to focus quite heavily on the financials and the resources. Now, this is not a bad thing, of course, because the banks and the mining companies are the ones that do tend to pay the highest dividends here in Australia. So it makes sense that a dividend-focused ETF would hold them as their major holding. So it's not bad, it's good to know what you're buying into when you're buying an ETF. So it really is a matter of just keeping it simple when you're choosing a dividend ETF. Make sure the fund manager is reputable. Make sure the fund you're looking at is a large fund. There's a lot of investors, so it's holding a lot of money, so it's unlikely to close. Look at the management fees and compare that to similar funds. But most of all, is it consistent and growing over time? There is no one best dividend ETF, although I do have some favorites. Now, I did say I would talk about my favorite dividend ETFs in this video, but because it's Christmas, I ran out of time and I didn't do any research, even though I kind of know which ones they are. So I'll do that next week, just do a really quick one before the end of the year, so we can go into 2026 with how to do research on actual companies, so we can start to put single companies in our stock portfolio if that's what you want to do. In the meantime, have a Merry Christmas, and I'll see you next week. Bye.